morning. Welcome to CATEX-TV. My name is Frank Fortunato. This is a live broadcast from Princeton, New Jersey. Today is Friday, February 6, 2009. It's 11:30 a.m. Eastern Standard Time in the U.S., 4:30 p.m. in London, 12:30 p.m. in Bermuda. If you need to contact us during the broadcast, you can phone in toll-free at 1-866-67-CATEX. Overseas, our AOL instant mail address is CATEX-TV. And thank goodness it is Friday. At least there presumably will not be too much bad economic news over the weekend. We do have some breaking economic news. We noted yesterday that Standard & Poor's had downgraded Swiss Re, and today it's Moody's turn. Moody's Investor Service has downgraded the insurance, financial strength, and debt ratings of Swiss Re and associated companies, and senior debt ratings down to uppercase A, lowercase a3. The ratings have been placed in review for further possible downgrades. Short-term ratings of Prime 1 were affirmed. So with some more fallout there. And now we'll go on to our main news. In the U.S., the jobless numbers came out this morning, and they're not good. The bad job situation only intensified during the month of January. The U.S. unemployment rate jumped up to 7.6%, while non-farm payrolls fell by the largest amount in 34 years. This is a Labor Department report from the government. Non-farm payrolls fell by a seasonally adjusted 598,000 in January, this after a loss of 577,000 in December. It's the largest payroll loss since December of 1974. Manufacturing saw its biggest decline in 26 years. Now 3.6 million jobs have been lost since the recession began just over a year ago, and half of them have been lost in the last 3 months following the collapse of Lehman Brothers. Total hours worked in the American economy fell by 0.7% in January. The average work week is now at a record low of 33.3 hours a week. Aon was in the news. The company said that their fourth quarter net income decreased 95%, all the way down to $10 million, compared to having made $207 million the year before in the prior year quarter. The decrease is primarily due to an expected $116 million after-tax loss on the disposition of the remaining property and casualty insurance businesses, as well as an increase in restructuring-related costs related to the Benfield merger. Net income from continuing operations decreased as well, 35%, to $123 million compared to $188 million for the prior year quarter. According to Greg Case, Aon's president and CEO, we did see continued progress in each of our key operating metrics. Organic growth was 2%, adjusted pre-tax margin increased 120 basis points, and adjusted earnings per share from continuing operations increased 19%. The UK business saw revenues for the year fall 3%, down to $742 million. For the fourth quarter, UK revenues dropped 12%, down to $196 million. On the reinsurance side, things were a bit better, with revenues rising 11%, all the way up to $1.003 billion. This is up from $900 million the year earlier. In the fourth quarter, reinsurance revenues jumped 18% to $247 million, up from $210 million in the fourth quarter of 2007. Some bad news coming out of Hartford. The group, Hartford Financial Services Group shares fell 21% in early trading today on the New York stock market. This after the company posted an $806 million fourth quarter loss and cut its dividend to preserve capital. According to some analysts, the drop in the stock price seems to be an overreaction, as the results are not so far from the range of outcomes that we might have anticipated. Quarterly net loss worked out to $2.71 a share, which is a reversal of net income from $595 million, or $1.88 a share, generated in the final 3 months of 2007, a year ago. Excluding net realized investment gains and losses and other items, Hartford said that its loss was $208 million, or 72 cents a share. Hartford Financial also said that it plans to reduce its quarterly dividend to 5 cents a share. The company paid a quarterly dividend of 32 cents a share earlier this month. Chief Executive Officer Ramani Ayer said, "We are optimistic about the resolve shown by the U.S. federal government in its efforts to stimulate the economy. However, the risks still appear to be severe. As a result, it's prudent for us to put capital preservation and risk mitigation at the forefront of our priorities in 2009. As a result of holding back the dividend, Hartford expects to save approximately $350 million of capital a year." More news regarding AIG. AIG has agreed to sell banking and credit card assets in Thailand to the Bank of Ayuda Public Company for $58.7 million. They've also managed to get the agreement of Ayuda to pay back loans to AIG totaling $477 million. Under the agreement, AIG will sell a 99.5% stake in AIG Retail Bank Public Company and all of AIG Card Company to the Bank of Ayuda, subject to the shareholder and Bank of Thailand regulatory approval. The deal is expected to close in April of 2009. The Insurance Day is reporting today in a front-page article written by Herbert Fromm from Cologne that Munich Re has achieved considerable price increases in the UK market at the latest renewal period, the January renewals, with Lloyd's syndicates needing to buy much more reinsurance and retro cover than in recent years. The article cites one of those all-powerful Munich Re board members, this time Torsten Jaworek. I'll go right to the article so I get it correctly. Mr. Jaworek said that Munich Re was highly satisfied with the latest renewals in London and the UK. He said with regard to the local UK market, renewals went very well. The UK is one of the few markets where the underlying primary prices are rising. Munich Re has a large customer base in the UK market, he said. It is present with a number of operations, including underwriting agency Bell & Clements, who it acquired in 2007. Jaworek said the hardening of the market was aided by a lack of fresh capital for reinsurers, both in the form of share issues picked up by investors and in the form of sidecars. Mr. Jaworek was quoted as saying, "Together with net cat losses, this has led the Bermuda market to be more disciplined than some people feared even in the U.S." He went on to say, "I don't think that the inflow of capital will come back in the short term. In 2009, we will see more cat bonds and similar forms as investors are seeking instruments that are unrelated to the normal credit market and its crisis." This is all good news for Munich Re, says Jaworek, because Munich Re has some money. He ended up the article by saying, "Today you have to ask who has the money to buy. When we acquired the Hartford Steam Boiler Company from AIG, one of the reasons for us winning that deal was that there were not so many others who could pay that kind of money." The Royal Bank of Scotland is making some news today. They announced last night that they've decided after all to keep their insurance business. This is 10 months after announcing that it was going to sell the business. The bank said that after careful consideration, the board of the bank, which probably includes the whole UK cabinet at this point, has decided that the insurance business falls under the category of businesses that have, quote, "a clear competitive advantage, credible future growth opportunities, and which generate appropriate risk-adjusted returns." According to Chief Executive Officer Stephen Hester, given our broader considerations, it was important to test the market for this business. It's been demonstrated that a sale on terms currently available would destroy value for RBS shareholders. RBS is conducting a strategic review of its businesses after, back in October, it unveiled a second capital increase in less than a year. That capital increase resulted in the group becoming 58% owned by the British government. Since then, a further capital restructuring has been announced, which could lift the government's stake up to 70%. CEO Hester said that the insurance business benefits from a leading market position, strong cash generation, and low capital requirements. U.S. stock market surprises up about 175 points. President Obama is set to announce an economic advisory team. Actually, he's speaking right now. I'm watching him on the monitor. Last night, the president took his first ride in Air Force One and left the White House and flew down to Williamsburg, Virginia, where he addressed a group of Democratic House of Representative members, and he exhorted them to work as hard as they possibly could to